Hi guys! Enjoy John's analysis.
There's a number that should concern every Bitcoin holder watching this video, 84%. That is the percentage of crypto holders who admitted to acting on FOMO, fear of missing out, at least once in their holding history. Not 84% of people who bought Bitcoin on impulse last year. 84% of people engaged enough with Bitcoin to participate in a structured survey about their investment behavior. That is from Kraken's FOMO and FUD survey, conducted in October 2024 across 1,248 participants. The same survey found that 81% had made decisions based on fear, uncertainty, and doubt, and 63% said those emotional decisions negatively impacted their portfolio. Now, here is the number that makes those three uncomfortable. On February 25th, 2025, when Bitcoin fell toward $86,000, CryptoQuant analyst Axel Adler Jr. published a note documenting that 79,300 Bitcoin, nearly $7 billion, had been sent to exchange wallets by short-term holders within a single 24-hour period. His description of the event: this is the largest Bitcoin sell-off of 2025. Those were not people who did not believe in Bitcoin. Those were people who believed in Bitcoin, held through prior volatility, and then, at the moment of maximum short-term pain, made a decision based on how the price felt, rather than what the blockchain said. Kai-Young Ju, CEO of CryptoQuant, has stated this pattern directly. In the 2021 bull market, Bitcoin fell 53% during what was still a bull cycle and recovered to reach a new all-time high. Holders who sold during that drawdown locked in losses and missed the recovery. His characterization of the behavior, buying when prices go up and selling when prices go down, is the worst investment strategy available. And yet, it is what the majority of holders have done, at least once in documented surveys. This video is about 4 specific mistakes that Bitcoin holders make. Not because they are uninformed, not because they lack conviction, but because they are responding to price instead of data. Each mistake has a documented mechanism. Each mechanism has a solution. And the solution in all 4 cases is the same: checking what is actually happening on the blockchain before acting on what the market feels like. Stay with me until the end. Because mistake number 4 is the one most holders are making right now in May 2026, quietly without realizing it, and it is the one with the most asymmetric consequences for what comes next. Before we get into the data, 30 seconds. Drop a comment below and tell me one thing. How many years have you held Bitcoin? Less than 1 year. 1 to 4 years. 5 or more. I ask because the 4 mistakes in this video affect each of those cohorts differently. And knowing who is watching shapes what I build next on this channel. Less than 1 year, 1 to 4. 5 plus. Drop it below. Now let us get into it. The holder who needs this video is not someone who made reckless decisions. You understood the investment thesis before most people had heard the word halving. You held through the China mining ban, through the FTX collapse in November 2022, through months when Bitcoin traded below $20,000 and financial publications declared the asset class permanently impaired. You watched your position recover. You watched it go from $15,000 to $40,000 to $80,000 to $100,000 to $126,272 on October 6th, 2025. You did the work. You had the conviction. And you still made at least one of the 4 mistakes this video covers. I know this because 84% of holders with your level of engagement have made at least one of them, according to documented survey data. The mistakes are not about intelligence. They are not about conviction. They are about the gap between knowing what the right action is and having a system that executes it when the emotional pressure of a volatile market makes the right action feel impossible. Research published in Springer's Digital Finance Journal documents that the disposition effect, the tendency to hold losing positions too long and exit winning positions too early, is present in Bitcoin markets and has been measurably more pronounced since 2017, not in uninformed speculators and experienced holders who understand the asset. The mechanism is specific. Under sustained price pressure, the emotional cost of holding builds until it overcomes the intellectual case for staying. The holder does not decide to act against their thesis. They simply reach a point where not acting becomes more psychologically expensive than acting, regardless of what the on-chain data says. The 4 mistakes this video covers are the 4 moments where that mechanism most consistently overrides holder behavior. And the solution is the same in every case. The market does not destroy Bitcoin holders through lack of conviction. It destroys them through lack of architecture. Here's what that means in practice. A 2024 behavioral study documented that investors who committed to written investment plans before market stress arrived were 60% less likely to deviate from their strategy during volatility. Not 60% better at predicting the market. 60% more likely to execute the plan they already built when it mattered most. Written, pre-committed plans reduce strategy deviation under market stress by 60%. Source: Bigot Behavioral Study, 2024. That finding is about the gap between intention and execution. Most Bitcoin holders have intentions. They know what they should do when the price falls or when the cycle peaks. What they often do not have is a written system that executes those intentions automatically, regardless of what the market feels like at the moment the decision is required. The 4 mistakes in this video are the 4 moments where that gap between knowing and doing costs holders the most. Each one has a specific mechanism. Each mechanism has a specific solution. And understanding both is the difference between holding through cycles systematically and holding through them with fingers crossed. Before the 4 mistakes, 30 seconds. We built something around exactly this problem. It is called the Bitcoin Holder's Bible, not a theory document, not a price prediction framework. A practical decision architecture, a written protocol system with a distribution ladder, a never sell core, and a weekly protocol check that converts on-chain signals into pre-committed actions you can sign, date, and execute before the pressure arrives. People who stay until the end of this video get a 50% discount code. The code is coming in the final block. Do not skip ahead. The context that makes the code meaningful is everything between here and there. Now let us get into the 4 mistakes. Selling when the price falls. This is the most documented and most costly behavioral error in Bitcoin's history, and it repeats with remarkable consistency across every cycle. The pattern is always the same. Price falls significantly, narrative turns negative. Every piece of content you encounter explains why the drop makes sense and why it might continue. The psychological cost of watching unrealized gains compress builds week over week. And somewhere between week 3 and week 8, the holder sells, not because their thesis changed, but because the emotional cost of staying exceeded the intellectual case for it. The scale of this behavior at the moment of maximum pain is documented precisely. When Bitcoin fell toward $86,000 on February 25th, 2025, short-term holders sent 79,300 Bitcoin, nearly $7 billion, to exchange wallets in a single 24-hour period. Crypto quant analyst Axel Adler Jr. described it as the largest Bitcoin sell-off of 2025. The STH SOPR metric, which tracks whether short-term holders are selling at a profit or loss, fell to 0.964, its lowest reading of the period. 79,300 BTC sent to exchanges in 24 hours on February 25th, 2025, largest Bitcoin sell-off of 2025. STH SOPR at 0.964. Sellers were exiting at a loss. Source, Crypto Quant Axel Adler Jr., February 2025. The crucial context: that sell-off occurred during what NYDIG research documents as a regular feature of Bitcoin bull cycles. Bitcoin experienced 10 significant drawdowns of 10% or more during the 2021 bull market alone. The current cycle, which began at the November 2022 low, had already experienced 5 drawdowns exceeding 10% before reaching the October 2025 all-time high. Drawdowns during bull cycles are not anomalies. They are the structure of the cycle. The mechanism that produces panic selling during these drawdowns is the same one documented in every asset class. Price becomes the primary signal, and price creates emotional responses that override the investment thesis. A 50% decline feels like existential threat. A 20% decline feels like confirmation of a top. Both feelings are responses to price, not to what is actually happening with holder behavior on the blockchain. The data that panic sellers ignore. Ki Young Ju of CryptoQuant stated it directly. Bitcoin fell 53% during the 2021 bull cycle and still recovered to set a new all-time high. The holders who sold at the lows of that 53% correction did not exit because the thesis failed. They exited because the emotional cost of the drawdown exceeded their architecture for handling it. What to do instead? Before selling because the price fell, check the LTH SOPR. The long-term holder spent output profit ratio on CryptoQuant. A reading above 1.0 during a price decline means long-term holders are still selling at profit. This is normal distribution behavior in a bull cycle, not capitulation. A reading below 1.0 means long-term holders are selling at a loss. This is the structural signal associated with cycle bottoms, not the beginning of a fresh decline. The holder who checks LTH SOPR before acting on a price decline is reading what the blockchain says, not what the price feels like. Those are different data sources with different reliability records. Price creates emotion. The blockchain creates evidence. Mistake 2, ignoring the halving cycle structure. This mistake is subtler than panic selling. The holder making it is often the more sophisticated investor, someone who has read about Bitcoin, understands the scarcity argument, and believes in the long-term thesis. But they are applying that thesis without the structural framework that determines when within the cycle the largest moves historically occur. The halving is the most fundamental supply event in Bitcoin's design. Every 210,000 blocks, approximately every 4 years, the reward miners receive for processing transactions is cut by 50%. The The fourth halving occurred on April 19th, 2024, reducing the block reward from 6.25 BTC to 3.125 BTC. As of that event, over 93% of all Bitcoin had already been mined. The price effect of each halving is not immediate. According to Use, the Bitcoin's analysis of the complete halving schedule, the pattern across all four halvings shows a consistent lag between the supply reduction and the price response. The bigger moves came 6 to 18 months after the halving, not immediately following it. The most precise data on post-halving timing comes from CoinDesk data analyst Daiwan, published in August 2025. His analysis documented that, historically, the most significant price appreciation for Bitcoin occurred between days 500 and 720 post-halving, and that Bitcoin peaked during that window in both the 2016 and 2020 cycles. Bitcoin's most significant price appreciation historically occurred between days 500 and 720 post-halving. Bitcoin peaked in that window in 2016 and 2020. Source: CoinDesk Data, Daiwan, August 2025. Rect Capital's analysis, published September 2024, quantified this further. In the 2015-2017 cycle, Bitcoin peaked 518 days after the halving. In the 2019-2021 cycle, it peaked 546 days after the halving. The current cycle, the April 2024 halving plus 518 to 546 days, points to a peak window between September and October 2025. Bitcoin's all-time high of $126,272 was reached on October 6, 2025, falling precisely within that historical window. Bitcoin peaked in October 2025, exactly within the 518 to 546-day post-halving window documented in prior cycles. Source: Rect Capital, September 2024. The structural data that most holders do not have? Fidelity. Digital Assets published a research report on June 18, 2025, that documented something unprecedented in Bitcoin's history. Since April 2024, an average of 566 Bitcoin per day has been entering what Fidelity calls ancient supply, coins that have not moved on-chain in 10 years or more. The current post-halving daily issuance is 450 Bitcoin. This is the first time in Bitcoin's history that ancient supply is growing faster than new issuance. 566 BTC per day aging into ancient supply, 10 plus years unmoved, versus 450 BTC per day in new issuance, the first time in Bitcoin's history that long-held coins are growing faster than new supply. Source: Fidelity Digital Assets, June 18, 2025. As of June 8, 2025, 17% of all Bitcoin falls into the ancient supply category. Fidelity projects this could reach 20% by 2028 and 30% by 2035 if current trends hold. What this means, structurally, the supply squeeze that halvings create is compounding with a growing base of coins that have not moved in a decade. The holders who understand this are not reacting to price cycles. They are observing a supply mechanism that operates regardless of short-term price action. What to do instead? Before making a major accumulation or distribution decision, map where you are in the halving cycle. The 2028 halving will reduce daily issuance to approximately 225 Bitcoin. With ETFs absorbing institutional demand and ancient supply growing faster than new issuance, the structural supply argument becomes more pronounced each cycle, not less. Decisions made without this context are being made without the most fundamental supply data available for the asset. Mistake 3. Emotional trading and overtrading. The third mistake is the one that produces the most consistent regret, documented in surveys, in trading records, and in the behavioral finance literature. And it is the mistake that most holders will recognize in themselves immediately when they hear it named. Overtrading is not about trading frequency. It is about the gap between decisions made with a pre-committed plan and decisions made in response to market stimulus, a headline, a YouTube video, a Twitter thread, a price movement that creates urgency to act. The Kraken survey is precise about the prevalence of this pattern. 58% of crypto holders said they frequently make investment decisions based on fear. 84% admitted to FOMO-driven decisions. These are not one-time events for most holders. They are a pattern of repeated small decisions made in response to market noise rather than pre-committed plans. The behavioral finance research explains the mechanism. A 2024 study documented that traders who committed to written plans before volatility were 60% less likely to deviate during stress events. The implication is direct. Written plans function as a buffer between emotional stimulus and action. Without the buffer, market noise and price movement become the primary decision drivers. The specific pattern. Springer's digital finance research documents in Bitcoin markets is the disposition effect, the tendency to hold losing positions too long and exit winning positions too early. The study confirmed this pattern is present across Bitcoin's holder base and has strengthened since 2017 as the market broadened. The mechanism: losses feel more painful than equivalent gains feel pleasurable. So holders hold through losses, hoping for recovery, and exit gains quickly to lock in the positive feeling before it reverses. Applied to Bitcoin, this produces two consistent outcomes. First, holders who accumulate late in a cycle, during the FOMO phase when price appreciation feels like confirmation of the thesis, and then hold through the entire drawdown because selling at a loss feels worse than the loss itself. Second, holders who exit early in a rally because the gain feels good enough and then watch the cycle continue past their exit price. 58% of crypto holders frequently make decisions based on fear. The disposition effect, confirmed in Bitcoin markets by Springer Digital Finance Research, makes this pattern systematically costly. The 2021 case study. During the bull run of 2021, thousands of retail investors purchased altcoins at all-time highs when the narrative was at peak euphoria. When the market corrected, they sold in panic. Investors who built positions systematically during the accumulation phase and held through the distribution volatility without changing their plan generated outcomes that were categorically different. This is not a story about intelligence. It is a story about architecture. The investor with a written system, who had defined their accumulation targets, their distribution triggers, and their hold parameters before the cycle moved, executed without emotional interference. The investor without a system responded to whatever the market felt like at each moment. What to do instead? Build the plan before the cycle moves, not during it. Limit price checking to once daily maximum during periods of high volatility. Use systematic approaches like dollar cost averaging for accumulation, the documented purpose of which is to remove the emotional timing decision from the equation entirely. Most critically, write down, in specific terms, the conditions under which you will add to your position, the conditions under which you will reduce it, and the conditions under which you will do nothing. Then execute the written plan rather than the emotional response. The 60% reduction in strategy deviation that written plans produce is not a small effect. It is the difference between a system that functions under pressure and one that dissolves the moment the market creates a feeling that conflicts with the plan. Mistake 4. Neglecting security. This is the mistake that surprises people most when they see the numbers. Not because it is conceptually difficult to understand. Every Bitcoin holder knows security matters. But because the gap between knowing security matters and having a system that actually implements it has proven to be wider than the data suggests it should be. The numbers from 2024 and 2025 are specific, and they are not declining. According to Chainalysis's annual report, approximately $2.2 billion worth of cryptocurrency was stolen through hacks in 2024. North Korean state-linked hackers alone were responsible for $1.34 billion of that total, 61%, across 47 documented incidents. $2.2 billion stolen in crypto hacks in 2024. North Korean state actors responsible for 61%, 1.34 billion source. Chainalysis 2024 Crypto Crime Report. The 2025 numbers are significantly worse. CertiK reported that $2.47 billion in digital assets were stolen through hacking incidents in the first half of 2025 alone, already exceeding the entire 2024 total before the year was halfway complete. The largest single incident was the Bybit breach in February 2025, $1.5 billion in a single attack, the largest theft in cryptocurrency history. $247 billion stolen in crypto hacks in H1 2025. Exceeding all of 2024 before the year reached the halfway point. The Bybit breach alone, $1.5 billion in a single incident. Source, CertiK, InfoSecurity magazine. The full year 2025 total reached $3.4 billion according to Chainalysis's December 2025 report, with North Korean hackers accounting for $2.02 billion, a 51% increase year over year. CertiK's analysis documented that wallet compromise, the exposure of private keys or recovery phrases, was the costliest attack vector in H1 2025, with $1.7 billion stolen across 34 incidents. And importantly, 85% of stolen funds had not been recovered as of mid-2025. Wallet compromise, private key exposure, was the number one attack vector in H1 2025, $1.7 billion stolen. 85% of stolen funds unrecovered as of mid-2025. Source, CertiK, InfoSecurity magazine. The structural problem. Exchanges are designed for trading. They are access points to liquidity, not long-term custody solutions. Every major exchange that has failed, and the list includes Mt. Gox in 2014, Quadriga CX in 2019, FTX in 2022, and now the Bybit breach in 2025, has produced the same outcome. Account holders who stored funds on the exchange lost access to those funds, regardless of whether they themselves made any security error. The data from the Bybit breach is instructive. The attack did not require Bybit's customers to do anything wrong. It required exploiting the exchange's internal systems. The customers whose funds were held in self-custody, hardware wallets, cold storage solutions, were not affected. The practical mechanism. The Bitcoin holder who keeps more than a working balance on an exchange is exposed to platform risk that self-custody eliminates entirely. An exchange can experience operational failures, regulatory actions, insolvency, or security breaches. A hardware wallet with a properly stored seed phrase and a documented recovery plan is not subject to any of these risks. The specific threat landscape has evolved in ways worth naming. CertiK reported that phishing attacks resumed as the costliest attack vector in Q2 of 2025, with $395 million in losses across 52 incidents. Attackers impersonating exchanges, wallet providers, and support services to capture private keys. What to do instead? The security framework requires 3 components. First, hardware custody for any Bitcoin you cannot afford to lose to exchange failure. The threshold is personal, but the principle is not. If the amount is significant to you, it belongs in self-custody. Second, a documented recovery plan written in plain language that someone you trust can follow if you lose access to your device. Between 1.5 and 2 million Bitcoin are estimated permanently lost due to inaccessible private keys, according to Chainalysis and River Financial 2025 research. Third, verification. Test your hardware wallet access and confirm your seed phrase backup is accessible at least once per year. A backup you cannot find when you need it is not a backup. The security conversation in Bitcoin content is often treated as secondary to the investment discussion. The data from 2025, $3.4 billion stolen in 12 months, suggests it deserves equal weight. The system. 4 mistakes, 4 mechanisms, 4 points, where the gap between knowing and doing has a documented cost. What produces that gap in all 4 cases is the same thing: the absence of a pre-committed system built in neutral conditions that executes regardless of what the market feels like when the decision is required. The holder who panic sold at $86,000 in February 2025 did not make that decision because they lacked conviction. They made it because the emotional cost of watching a $7 billion sell-off unfold, with no written framework defining what conditions would actually warrant selling, was more than their existing architecture could handle. The holder who ignored the halving cycle window and distributed at the wrong phase did not fail because they did not understand the thesis. They failed because understanding the thesis without a calendar and a set of defined triggers is still just knowledge. Knowledge without architecture dissolves under pressure. The holder who overtraded during the 2021 FOMO peak and bought altcoins at the top was not impulsive by nature. They were responding to market stimulus in the absence of a pre-committed plan that would have prevented those decisions. And the holder, whose 12 Bitcoin sits on an exchange because they have been meaning to set up cold storage for 2 years, is not irresponsible. They simply never built the 30-minute process that converts intention into action. The system that closes all 4 gaps has 3 components. The weekly protocol check, 5 minutes once a week. Check LTH SOPR on CryptoQuant. Check MVRV Z-score on MacroMicro. Check NUPL on Glassnode's free tier. Check RHODL on Bitcoin Magazine Pro. Ask 1 question. Has any signal in my written protocol been activated? If no, close the application. The protocol tells you when to act. When nothing is triggered, no action is required. The distribution ladder, not a price target. A signal-based trigger system with 3 predefined rungs activated by on-chain conditions, not by how the price feels. The stable coin cycle index fired a sell signal on September 22nd, 2025, exactly 14 days before the all-time high. The holders who had that trigger in their written protocol distributed near the peak. The holders who did not watched the signal fire without anything to execute against it. The never sell core. The percentage of your position you commit to holding regardless of price, cycle position, or market narrative. Defined in writing, in neutral conditions, before the emotional pressure arrives. This is the buffer that prevents panic selling and drawdowns from costing you the recovery that follows. These 3 components are not sophisticated. They are specific. And specificity, not sophistication, is what converts intention into execution under market pressure. Most people watching this video already know which of the 4 mistakes applies to them. You know if you have sold into a drawdown and regretted it when the recovery came. You know if you have ignored the halving cycle structure in your timing decisions. You know if you have made trades based on a headline or a price movement that you would not have made if you had slept on it for 48 hours. And you know if your Bitcoin security setup is less complete than it should be given what you are protecting. The Kraken survey found that 63% of holders say emotional decisions hurt their portfolio. That is not 63% of uninformed people. That is 63% of people engaged enough with Bitcoin to think carefully about their own behavior. Knowing you have a behavioral problem is not the solution to the behavioral problem. A written system built before the pressure arrives is the solution. The 4 mistakes in this video are not primarily information problems. They are architecture problems. The holder who panic sells at the bottom of a drawdown is not missing information about why they should hold. They are missing a pre-committed protocol that defines the specific conditions under which selling is the correct action and holds them to that definition when the emotional pressure to deviate is highest. The 60% reduction in strategy deviation that written plans produce is the most reliable performance improvement available to any Bitcoin holder. It does not require market prediction. It does not require superior analysis. It requires building the plan before the market tests it. You made it. You just spent 30 minutes with 4 mistakes, 4 mechanisms, and 4 solutions. Let me make this concrete before I give you the code. Think about the 4 mistakes and the documented costs. Mistake 1, panic selling into a drawdown. The holders who sold during Bitcoin's 53% intracycle correction in 2021 locked in losses and missed the recovery to $69,000. The holders who sold near $86,000 in February 2025 missed the recovery. The mechanism is the same in both cases. Mistake 2, ignoring the halving cycle. Bitcoin peaked at exactly the 520 to 546 day post-halving window that historical data had predicted in September 2024. The holders who understood this framework knew the cycle was in its final phase. The ones who did not were making timing decisions without the most relevant structural data available. Mistake 3, emotional overtrading. The 60% reduction in strategy deviation produced by written plans is not a theoretical improvement. It is a documented behavioral difference between holders with architecture and holders with intentions. Mistake 4, security gaps. $3.4 billion stolen in 2025. 85% of stolen funds not recovered. The gap between having Bitcoin and being able to access it in 10 years is a seed phrase backup and a documented recovery plan. The Bitcoin Holder's Bible addresses all 4, not with theory, with practical architecture. The distribution ladder with 3 predefined signal-based rungs. The Never Sell Core worksheet, the weekly protocol check, 5 minutes, 1 question, same process every week. The security framework, including self-custody setup, seed phrase, backup protocol, and the inheritance documentation that protects the position beyond your lifetime. And 6 composite holder profiles documenting exactly how conviction succeeds and fails in practice, including the holder who survived every downturn and still sold near the bottom because he had no written framework. The regular price is $54. For everyone who stayed until the end, the code is holder26, HOLDER26, 50% off, $27. That code is for this video only and expires when the next video in this series goes live. Let me put $27 in context. The holders who sold at the $86,000 panic sell in February 2025 and missed the subsequent recovery lost on a 1 Bitcoin position, approximately the difference between $86,000 and the recovery level, before accounting for the compounding they gave up. The system that would have prevented that decision costs $27. The holder whose Bitcoin is on an exchange without self-custody documentation is exposed to platform risk that the Bybit breach proved is real. Setting up self-custody is free. The protocol that tells you how to do it systematically is $27. Code is holder26. Link is in the description and pinned in the comments right now. Before you close this video, 1 action. Which of the 4 mistakes resonates most with your own history? 1. Selling into a drawdown you later regretted. 2. Making timing decisions without tracking the halving cycle. 3. Overtrading based on emotion or market noise. 4. Having a security setup that is less complete than what your protecting warrants. Drop the number in the comments, just the number. 1, 2, 3, or 4. Not because the algorithm rewards engagement, though it does, because naming the specific mistake publicly is the first step of the system. The comment section of this video is the beginning of the audit. If you want the complete framework, the distribution ladder, the Never Sell Core, the weekly protocol check, and the security documentation, the Bitcoin Holder's Bible is $27 with code HOLDER6. Link in the description. The next video in this series covers what the on-chain signals are actually saying about the next move. The 5 metrics that have called every major Bitcoin cycle turn, their current readings in May 2026, and what the convergence of those readings implies for holders in the current market structure. Subscribe so you do not miss it. And if this video gave you something you can use, share it with 1 Bitcoin holder you know who has made at least one of these 4 mistakes. The data says that is almost everyone. And the cost of repeating it in the next cycle is significantly larger than the cost of having a system that prevents it.